The Canadian equity market has been resilient despite geopolitical headwinds, but with growing risks, is the TSX still well positioned compared to its global peers? Joining us now to discuss is TD Asset Management's Michael O'Brien. Michael, welcome back to the program.
Hey, great to be here, Greg.
We're not quite at the halfway point of the year, but it's getting warmer here, so I'm starting to feel it. The markets, we got a lot of ugly headlines. We've had them for months and months and months now. The markets continue to perform and just continue to move higher. What's the dynamic here?
Yeah, well, I think what's really saved the day, despite all the pretty unsettling headlines nonstop, it feels like, I think what's really saved the day for the first part of this year has been very strong earnings delivery from companies across North America, really. The magnitude of, both the earnings beats, but also the earnings revisions has been very rare that you see that strength. And so I think that's really, despite all the headwinds, despite concerns about the Middle East, despite, still some trade frictions here and there, it's really been that underlying earnings growth. And I think a lot of that, fueled by this enormous AI capital spending boom. That's really been what's held us in so far. We're kind of getting to an interesting point, though, that old market adage, the market climbs a wall of worries. There's certainly been no shortage of worries. But, there's a limit to how high we can climb. And, I think we always want to be on the lookout for that. Two of the things that have sort of been popping up, in the last few weeks here that have caught people's attention. First of all, the Strait of Hormuz is still closed, despite periodic updates from Washington, trying to convincing us that it's just about to be over. Strait is still closed. And so, we thought maybe the worst of the oil price surge was behind us a month ago when we got the ceasefire. Lo and behold, we're still, seeing that crude print, creep higher as we go. So I think the longer the strait stays closed, the more serious the implications are, for the economy, broadly speaking. And the second thing, which is kind of tied to this, is I think a lot of investors, certainly coming into the year, a lot of investors were optimistic that we'd have rate cuts, that we'd see a bit of a disinflationary period. Instead, we've kind of been getting the opposite, where inflation prints, certainly south of the border, have been coming in hot. Canada's been a little better behaved, well, actually much better behaved than the CPI print. But as a consequence, what we're seeing is bond yields have started to, creep up to what I would call unsettling levels.
Yeah, it's pulled back today, but we hit like over 4.6 and only actually on my screen here. So February 27th, this would have been like the outset just before the start of the conflict in the Middle East. We were just below 4%. There's been a big move in yields.
So it's been a big move in yields, and so what we're seeing now at the long end of the curve, 10-year, 30-year bond yields, they're back to levels that we haven't seen really since 2007, 2008, 2009. So those are kind of levels where I think it's going to test the market a bit. So, I think we're kind of getting to an important juncture. We need to get that strait open. We need to get the oil flowing. We need to see some relief on the bond yields, or it's going to be a bit tougher slog uphill for the markets from here.
Maybe we can look at it as the bond market reacting to these tensions in the strait and how long we've seen it closed for. Any sense, too, that the bond vigilante, people when they start doing moves like this, this is actually the bond market now trying to tell policymakers we're not happy with what's happening here?
Well, I think that's always part of it. And, it's so far, every time people have put out the bond vigilante cry, the vigilantes are back, the bond market's going to whip the governments into shape. They've tended to back off pretty quick. And so all these key levels, whether it's 4.5% on the 10-year, 5% on the 30-year, all these levels, they get tested, but then they've continued to fall back into this broad range we've seen for yields really for the last couple of years. The real challenge will be if one of these key levels breaks and the line just keeps going up. So far we haven't had that, but clearly the bond vigilante concern is out there. And, and it's not just about oil prices. It's not just about energy prices. If you think about it, I made a reference to AI, CapEx spending. I think the estimate is from, the 4 or 5 big players, they're looking at over $1 trillion of spending next year. That's just a stupendous number. I think increasingly people are starting to realize, that has a bit of an inflationary impact too. If you've got pressure, all these bottlenecks and power and memory prices and just the raw commodities that go into it, it's more of a broader inflation story than maybe people thought at the beginning of the year. So,
Energy, raw commodities get me thinking about Canada, right? I mean, this is what
Yes.
we had to sell to the world.
Yes.
Considering all the turmoil and everything that's happening, how is Canada positioned through all this?
Yeah, well, it's the line I've been using is I don't think we would have wished for this, but now that we've got it with the biggest energy crisis and at least since the 70s, if there's one country you're going to pick to be in, Canada would be the place. We're a big exporter of energy, both oil and natural gas. We're relatively insulated geographically from the turmoil and the disruptions to supply chains. And if you look at the composition of the TSX, the Canadian equity market, we have an enormous energy sector relative to just about anybody else. I think it's about 4% of the S&P 500 is energy. It's like closer to 18, 19, 20% in Canada. I'm not sure what it is today. So 4 or 5 times the type of exposure. So both the relative insulation from an economic perspective and that leverage to energy prices that is a positive for those energy stocks, it puts Canada in a relatively advantaged position.
When I take a look at it, you're talking about the composition, obviously we have financials, we have the miners as well. It's not just the energy stocks that have been working for the Canadian market. Can we expect that kind of resilience going forward? We're still about a week away from Canadian bank earnings, but things have been performing pretty well.
Oh, it's been a very, again, when you stop and think about all the negative, ugly headlines that we've been seeing, pretty much nonstop this year. The fact that the TSX is up, high single digits year to date is a very strong showing. And you're right. I mean, the banks, which are going to be reporting in the next week or so, they have been absolute leadership. They've been very, very stellar. So this has not been a one-trick pony at all. The financials have definitely been holding in there. So I think really the key to can this continue is going back to what has held us in so far is this very strong, better than expected earnings growth we've been seeing. That has to continue. The economy has to continue to hold in there. The banks, especially if you think about the historical context, the banks are trading fairly rich by historical standards. And so I think as an investor, the expectation is they will deliver. And frankly, they better deliver. They're priced to beat expectations. As we sit here today, the setup is pretty good. But that's at the end of the day, that's the key. And that's why I think it's really important to have a fairly balanced, sober outlook at where we're at today, where we've made a lot of progress. We've chewed through a lot of negative headlines. But the reality is, if the Strait of Hormuz stays closed for much longer, we're going to see increasingly negative real-world economic impacts. The origin or the first manifestations of that are not going to be here in North America, where we're relatively insulated from both from a geographical and from an energy independence state. But areas like Asia, Europe, increasingly are going to get impacted, and it is a global world after all. And so like I say, the longer the strait stays closed, the more serious the economic ramifications are. And so, I think thing one that we need from stocks is they need to continue to deliver earnings. Thing two is we need to get energy flowing again. We need to get this energy crisis addressed before the impacts become what I would call nonlinear or much more severe, sort of that fall off a table type of moment. So that's what we need to avoid. The news today is yet again, talks are making progress. Who knows? But, the clock is ticking, so we need to keep that in mind.